that mean the cameras are on?
The cameras are on.
Great, thank you, Diane. Okay, good morning, everybody. Welcome to the June 16th Common Investment Meeting of the New York City Retirement Systems. We're going to start by calling the roll. Let's start with the Fire Pension Fund. Mr. Dunn.
Good morning, Mr. Adler. For Mayor de Blasio.
For Fire.
Cynthia Collins, designee for Mayor Bill de Blasio.
Thank you. For Controller Stringer.
For yours, you don't have to worry about this year when they call for you.
Okay,
John Dorsett, designee for Controller Scott Stringer, awaiting the arrival of Jennifer Conowitz.
I'm sorry, my mute did not work. Unmute did not work. I am here.
Okay, Jennifer, record will note that as well. For Commissioner of Finance.
Shuman Ray for Acting Commissioner, Finance Commissioner, Drew Sullivan.
For the UFA, Andrew Ansbro.
Eddie Brown has a proxy for Andrew Ansbro.
Okay. Robert Eustace.
Robert Eustace, virtually present.
Eddie Brown.
Here.
Eric Bischoff.
Present.
Peter DeVita.
John Young with Peter DeVita's proxy.
Okay, thank you, John. For the UFOA, Jack Kelty.
Here.
Liam Guilfoyle.
Here.
Paul Mannix.
Jack Kelty with Paul Mannix, temporary proxy. Should be here in a minute.
Okay, and for Fire Commissioner Daniel Nigro.
Carol Burr for Commissioner Nigro.
Good morning, Commissioner.
And Pat, let the record reflect that Steve Young is present, but his Zoom microphone and camera's not working properly, but he will be attending the fire meeting.
Okay, thank you.
And Mr. Dunn, Paul Mannix is here.
If I didn't call you Paul, my apologies.
You did.
we have a quorum. Okay, thank you. I thought you were calling someone else named Steve a quorum or something like that. Okay, thank you, Pat. Next, let's do the Teachers Retirement System. Mr. McTeague.
Thank you, John. John Adler.
Yeah, I'm here.
Thomas Brown.
Morning, Thad, I'm here.
Natalie Green Giles.
Here.
David Kazansky.
Good morning, everyone. I'm here.
Russell Buckley. Deborah Penny.
Good morning. I'm here.
And John Dorsett.
Good morning, I'm here.
John, we have a quorum.
Thank you, Thad.
Thank
Next,
you.
let's do NICERS. Ms. Winery.
Morning. Chair, Mayor's Office,
John Adler, present.
Comptroller's Office,
David Jeter for Controller Scott Stringer, present.
Public Advocate's Office,
Elizabeth Guzman for Public Advocate Juman Williams.
Borough President Manhattan,
Matthew Washington from Manhattan Borough President Gail Brewer.
Borough President Brooklyn,
Tanya Cantlow for Brooklyn Borough President Eric Adams.
Borough President Bronx,
Martha Camille Sabio for Bronx Borough President Ruben Diaz Jr.
Borough President Queens,
Alan Swisher for Queensborough President Donovan Richards.
Borough President Staten Island,
Isaac Gordetsky for Staten Island Borough President James Otto.
International Brotherhood of Teamsters,
Ruben Torres and Lawrence Bosley for President Gregory Floyd.
Transport Workers Union,
Dave Katzman for TWU Local 100 President Tony Otano.
and District Council 37.
Raymond Santander as designee for Executive Director Henry Garrido, and Robin Roach, if she's here.
We have a quorum.
Thank you, Melanie. Police Pension Fund, is it Mr. Holloway?
Yes, it is. Good morning. Representing the PBA.
Joseph Alejandro, PBA.
Betty Cavadero, PBA.
DEA.
Kenny Sparks, DEA.
SBA,
Anthony Borelli, SBA.
LBA, CEA,
Good morning, Chris Monahan, CEA.
okay, Commissioner of Finance,
Bill Dukes for the Finance Commissioner.
Thank you.
okay, representing the mayor,
Jim Monray, representing Mayor Bill de Blasio.
Controller,
John Dorsett, designee for Controller Scott Stringer.
and the police commissioner.
Stephanie Zenberg, representing Commissioner Shea.
We have a quorum.
Thank you, Kevin. And for BRRS, the Board of Education Retirement System, Mr. Rich.
Good morning, John. We are represented today by Natalie Green Giles. Thank you for attending, Natalie. We do not have a quorum. We will administer this business at our next Board of Trustees meeting, which is scheduled for June 24th.
Thank you, Sandy. Okay, public meeting now commences, and I'm going to call on Chief Investment Officer Alex Donier to lead us through the quarterly performance review.
Good morning, John. So are we leading with the performance review or the other market overview?
You're in charge. You take us through the, how you want. I think of the public markets overview as part of the performance review, but.
Understood. Well, good morning, trustees. I hope everyone is doing well. I think we'll just maintain the order that we typically have for our quarterly presentation. I'll have Mike Haddad first present the first quarter market update. He'll review the system's asset allocation and rebalancing activity in the quarter and some recent trends in the market since the end of the first quarter. I will follow with the presentation of the first quarter 2021 system returns, and we'll have Dan Haas from the risk team present the first quarter risk report. So with that, I'll turn it to Mike Haddad.
Thanks, Alex. Good morning, trustees. Just checking to make sure that you all can hear me well. All good?
All
Okay.
good.
Okay.
Mike, are you able to see the screen?
I am, Diane. Thank you.
Okay.
So as Alex indicated, I'm going to kick off and talk about Q1 public markets performance, attach a narrative to that performance, talk about some recent trends, and then spend some time on rebalancing activity and your actual asset allocation. So let's just jump in. Next slide, please. So as you can see here in the first column labeled Q1, here are the returns for the benchmarks for all of your portfolios. And I would typify it, a few takeaways from this performance is one, equity markets for the fourth consecutive quarter had a positive return following Q1 of 2020. And you'll note that US is back outperforming, but I will note that Q1 was also associated with a stronger dollar. So the EFI and EM returns were in local currencies were actually higher than US, but in dollar terms, they were not. And then I would also just take your eyes over one column further to the 1-year numbers, and you can see they're just stunning. So said differently, the rally from March of 20 to the end of March of 21 was absolutely extraordinary. As the economy recovered, as fiscal policy kicked in, and as the Fed eased massively. The other takeaway from Q1 is the red numbers you see associated with fixed income. Treasury yields rose meaningfully in Q1. 10-year yields were up 83 basis points. That's resulting in strong negative returns in the Treasury component of your core fixed income portfolio. And the Barclays Ag was actually negative for the quarter as well. High yield, you can see at the bottom, had a slight positive performance as spread tightening was greater than the rise in yields for high yield. Next slide, please. So how do we explain these, the returns in Q1? So in our opinion, two key drivers of the returns and both the successful vaccine production and the rollout to all the states, leading markets to anticipate the economy reopening. Second part, again, fiscal stimulus. Following the Georgia elections in early January, where the Democrats won both, markets started realizing that the Democrats had control of president, the Senate, and Congress, and thus they were able to push through the American Recovery Plan, which is a $1.9 trillion plan. This is on top of the $4 trillion that was done in 2020. So that was very supportive of growth and also supportive of rising interest rates. So again, the key takeaways from Q1, increased inflation concerns and rising long maturity yields, as well as strong positive equity returns, but with the continuation of the equity sector rotation. Next slide, please. So let's dig a little bit deeper on the equity sector rotation. The slide on the table on the left shows in the first column for growth minus value, several different indices. And what you can see, Q1 all red, meaning that growth underperformed value in all market caps in the U.S. And even in MSCI World. That's another way of saying the EFI index, and even in EM. 3-year numbers we're also showing because growth has still outperformed on a three-year basis, although those numbers are narrowing. So if we switch to the right part of the slide, what sectors led the recovery? What sectors led the equity market rallies? We start with energy, which had a stellar quarter in Q1, alongside a rise in oil prices, although you can see the 3-year number is still quite negative. And you'll hear Alex throughout his slides when we talk about different managers' performance, those who benefited from being exposed to energy and those who did not benefit. Bottom part of the slide, what equity sectors were the worst performers? And you can see at the bottom of the table, technology, barely up on the quarter. But then again, if we look at the 3-year number, you see that the 3-year return is absolutely spectacular. So some reversion to the mean, if you will, but longer term growth still outperforming everything else. Next slide, please. So turning to fixed income. On the left side of this slide, we see the U.S. Treasury 10-year inflation break-even slide, and this goes back 20 years to the beginning of the century. So, beginning of the century. So a couple takeaways from here. One, if you see the very strong rise on the recent rise in inflation expectations from the trough in the pandemic, you can see that shot up from almost 50 basis points to almost 250 basis points, with Q1 highlighted there. The second takeaway is you see absolutely how high inflation expectations have become relative to where we've been over the past 20 years. And although inflation expectations have been higher, you can see we're at or near where we've been during that time period. Important to note, if you look pre-GFC, so if you can see on the x-axis there, it's kind of small, I apologize. 04 to 07, inflation expectations kind of averaged 2.5%. So if you look now and say, what's the big deal? Well, 10-year yields back then were probably more around 5%, where 10-year yields now are 150 basis points. So despite having similar market-based inflation expectations, yields are meaningfully lower. So speaking of yields, on the right-hand slide, you can see for various sectors, the rise in the various maturities, the rise in yields in Q1. And you can see in the second column year to date, some of those, apologies, that 5-year number should be minus 44 basis points. You can see all of the movement year to date happened in Q1, as yields have actually been down in Q2. Next slide, please. So what are we concerned about going forward? We've talked about this, it seems to me, at every sim, but based upon various valuation measures, US equities are historically expensive. So let me delve in a little bit deeper on that. If you look at the table on the top of this slide, you'll see 6 different valuation measures. The first 5 all relate the price of stocks to some other valuation measure. I won't read through them all, but the takeaway, if you go to the far right side of that table, that's the standard deviation, overvalued, undervalued. positive number means it's overvalued. So you can see based upon all those valuation metrics, the US equity market is historically expensive as measured against the past 25 years. The last row in that table measures the earnings yield versus a corporate yield. So said differently, that's the earnings on the equity market versus a long dated corporate yield. And you can see on that measurement, the equity market is not expensive. It's actually cheap to where yields are. So we're going to spend some more time on yields, but let me just finish up on PE ratios. So if we actually look at the line on this slide, the forward PE ratio, and you can see on the far right, as of the beginning of the month, we're a little bit over 21 times forward earnings. And you can see how that compares over the past 25 years. And other than the NASDAQ bubble, this is as expensive as US equity markets have been. Next slide, please. Why do forward PEs matter? There's two different regressions on this slide, and it compares the forward PE to subsequent one-year returns on the left-hand side. And you can see the relationship there is kind of messy. The R squared at the bottom is very low, meaning there's very little correlation between forward PEs and subsequent one-year returns. But if we go to the right-hand part of this slide, this compares subsequent 5-year annualized returns. And you can see that number is right around 0. So if history were to hold, which is no guarantee, forward returns on the equity markets are not optimistic. The conclusion of this regression is very similar to the GSAM slide that we've shared with you many times, which divides the equity market into 10 different deciles. And we are still in the 10th decile, which again would predict based upon history, zero-ish kind of returns for the next 5 years. Next slide, please. So here's another glimpse of forward PEs, but as related to inflation expectations. So the slide on the left, this is survey-based inflation expectations. So this is based upon a University of Michigan inflation expectations. The purple line shows the 1-year inflation expectation. The dark line is the 5-year. And you can see, again, the rapid move up over the past several months. And again, compared to history over the past 20 years, we are at or near the highs of where we've been. And then if we look on the right-hand slide, let's tie in why that matters. So this slide shows inflation expectations along the x-axis, forward PEs along the y-axis. That red dot represents where we were about a month ago. And what you can see over the past 20 years or so, when we've had inflation expectations around 2.5%, the forward PE has been a lot lower than that. Said differently, that would mean a different equity market valuation. Next slide, please. So speaking of inflation, here is core CPI and core CPI going back 50 years. The table in the top here shows the actual data for May. Again, I think I have a bad number in here. I think that number printed 5.0%, not 4.9. There must be some rounding there. Apologies. But you can see the inflation numbers have moved up meaningfully, and this gets to the heart of one of the major questions in markets, as well as what the Fed is going to be debating today. And we'll hear the results of their meeting sometime later this afternoon. Question is inflation transitory or not? Obviously, we don't know. That's the forward-looking view on inflation. But if inflation is transitory and it is going to revert back to around 2%, then interest rates should be relatively well maintained, although we still think they should be headed higher. Inflation is not transitory, then the Fed's current monetary policy setting of 0 rates and massive QE is out of sync with the economic recovery. Next slide, please. So for those of you who follow the Fed in the minute detail, what they actually target is the personal consumption deflator, not CPI. There's some different measurement techniques, but directionally they correlate to be the same. So this number is lagged by a month because we haven't gotten the May one. So that will probably tick up to about 3.9, maybe even 4%. And then in the purple line, if you can read that tells you what is required over the next 3 years to make up for the undershooting of inflation over the past 10 years. So, and this is what the Fed wants to happen. They want inflation to make up for the time it was under target, and they want it to be above target. First time the Fed has tried this. This is a major change in policy they adopted in August of last year, and now we're living with it, and we will see how markets handle it. Next slide, please. So speaking of interest rates, what this slide shows is just a look at the range of Treasury yields over the past 10 years. And that range is indicated by the gray bar on this graph. And just walking you through it, the lowest line on the graph is where yields were in August of last year. And just looking at the 10-year point, you can see there are 52 basis points. That middle blue line is where we were just a few weeks ago. And that top gray line is where yields were in December of 2013. And the point of this is just to show you that yields remain very, very low, even looking over the last 10 years. And the last point I would make, another way that we can look at yields is the 10-year minus the CPI. Again, the 10-year is currently around 150, CPI running at 5%. That's a negative 4.5%. And other than a handful of times in the late 60s and the early 70s, real 10-year note yields have never been this low. And again, for those who've studied history, that time period coincided just before the great inflation outbreak. So let me pause there for any comments or questions on Q1 risks to the equity markets before I jump into rebalancing and asset allocation.
Thanks, Mike. If you have questions, if you can hit the raise hand button, which is now in the reactions tab in your Zoom. On my page, it's at the bottom of the page. If you're using an iPad, I think it might be in the top. If you have a question or comment for Mike, hit the raise hand. Got a UFOA question?
Yes. Just for point of information, this is first. This is Jack Kelty.
For the record.
Jack Kelty from the UFOA. This is the first quarter update, right? The end of March numbers we're going through. Correct?
Morning, Jack. The public market numbers were for Q1, and then I kind of leaped into some forward-looking concerns, which had data through June. So it's a mix of two. I apologize for that.
Okay, that's why I wasn't sure. And the other question I want to know, just moving forward, in your format, we got the 2021 annual BEN compliance update. And on page 1 of that, you've got a timeline. In 2018, you have public market accounts moved from monthly to daily monitoring. If you can monitor things daily, can we get quarterly updates more than months out of date going forward? Just saying there, I'd like to try to compress, and with today's technology, I think that shouldn't be an overreach to get a quarter a week or two before the end of the next quarter. Only point.
Jack, I share your desire for more current information. It's a little bit complicated in that the marks we receive from our custodian, State Street, we receive monthly. To change that to daily requires a meaningful increase in cost. And it is something that we are looking at as we are, cognizant of the desire for more accurate reporting. There's many other things involved in it, but it is a project that we're working on.
Okay.
Your compliance report, you said you had it done daily, so I was just curious why there was such a delay if you're getting daily public market reports.
Not to speak on behalf of Suchi, but I believe what she's referring to is through the monitoring of the various compliance checks that is run. That is now done daily versus monthly, but I will let her address that during her time.
I don't know if that's why I was just a little confusing for me reading it, so I was asked the question.
I'm happy that you're reading the materials.
Other questions for Mike or comments? So Mike, we've been in the, how long have we been in this 10th decile of that Goldman Sachs chart that's not in this report but that we've seen Can you estimate that?
If you recall in 2018, the equity markets had a really tough, a tough sledding. And I think then we slid down to the 8th decile. But other than that, in my time with BAM, which is now 5.5 years, I'm going to guess we've been in the 10th decile 80% of the time, something like that.
Okay, so it's a good thing we didn't take that too seriously, or we would have lost this if we had really, and we did actually diminish our equity exposure in our across all the funds in our asset allocation. But of course, Monday morning quarterbacking or 2020 hindsight or whatever. But frankly, this market environment that we've been in kind of defies expectations, I would say, and even today, looking at those measures and saying, oh, we're overvalued and we're primed for fall. Maybe we are. And yet, again, I think most economists think that the sort of next, you name it, how long, but looks like a period of growth. And maybe that's maybe that growth is already built into equity valuations. And so, we can't expect equity valuations to fall because at some point the growth is going to stop and the music's going to stop, right? And the fiscal stimulus is going to run out and so on. But it sure seems like valuations have defied traditional measures as exemplified by that Goldman Sachs chart.
I would offer a different explanation.
Okay.
And if you go back to that table, Diane, can you go back to the risk to equity markets, the first one that showed the forward PEs?
It's slide 7. I think.
So the forward one, please. Forward one, forward.
Yeah.
Yes, thank you. So the first 5 of those valuation measures all speak to price versus something. And that GSAM decile chart, I think if memory serves, it had 7 different models, different valuations in their model. And when you use that valuation measure, then stocks show up as expensive and your points are well taken. If you go to any valuation measure that measures equities versus fixed income versus yields, equities show up as cheap. So the way that I would characterize the market, the equity market, it has benefited massively from the low interest rate environment. And thus, to me, the critical component for the equity market maintaining its valuations, even going higher, is that interest rates stay, not necessarily right here, but don't go back to where we were, say a 10-year note, 3% and higher. And to me, that's the most important thing to watch for us going forward. And just as a reminder, what's different this time post the pandemic versus post GFC, the amount of fiscal stimulus is in excess of 5 times what we had back then. Yet interest rates are even lower. So the Fed holding policy rate at 0, doing more QE, I think 3 times as much QE post-pandemic as compared to GFC, still doing it when Q2 is likely to print in excess of 10%, inflation of 5%, and we have a 1.5% 10-year note. That historically we've never seen before. That type of growth in inflation data is typically, you would expect yields of somewhere, 10-year yields of 4 to 5%. So the question, that's why this massive question in the press that the Fed's dealing with is inflation transitory or not is huge to not only interest rates, but how interest rates impact the equity market. And I don't think we know. We do know that from 2000 and on, the technology has massively been a disinflationary force to the economy, as well as globalization of labor, as well as aging demographics in most developed markets. But we've never seen this circumstance of the amount of fiscal stimulus. Actually, we saw it after World War II. And 20 years later, we ran into a massive bout of inflation. We've never seen money supply increase this much. We've never seen the Fed this accommodative while we have explosive growth. growth in excess of where we were in the pandemic. So the key is interest rates to me, and that is how I square the circle of these expensive equity valuations. It's all dependent upon interest rates staying at or near these yields. You know, and then furthermore, what's aided our yields staying down is foreign yields being negative. You know, the policy rate in Europe is minus 50 basis points. You know, again, an anomaly in history. Is this what we're going to be dealing with going forward? We don't know. But you know, to pay someone to take your money doesn't seem to me to be a normal state of affairs.
Okay. Thanks, Mike. Anything else for Mike Haddad? Okay, thank you.
John, I still got to do some rebalancing and asset allocation.
Okay, go ahead.
Yep. Yeah, thanks, Diane. So this is a summary of your rebalancing activity in Q1. On the left-hand part of the slide, it's per system. The red is asset classes that we sold. The green are asset classes that we bought. The summary is on the right-hand side of this slide. And before I go into the takeaways, it's important to note that throughout Q1, all of your portfolios were slightly overweight equities, slightly underweight fixed income. So as you see in Alex's slides, all systems benefited from these slight overweight and underweights that we had. But if we look at the right-hand side, the key takeaways here, if you look at the last 3 rows on the outflows, that's all equity market outflows. So as equity markets rallied and you, all of your portfolios were overweight US equities, we took profits. You know, it's kind of a mechanical thing we do when things get overweight. Within your rebalancing ranges, we reduce those overweights. And what was underweight was fixed income due to our positioning as well as rising yields, which decreased the AUM. So you can see some of that as well. The second takeaway is you'll see some big numbers associated with movements in and out of the cash desk and into various sleeves of your treasury portfolio. So what was happening there? As we were selling equities, we really didn't want to invest in fixed income because we had a negative view. But again, due to the rebalancing process, we maintained our discipline. And some of those numbers were to get those various sleeves closer to their targets and to keep your durations at or near your targets. So speaking of your targets, next slide, please. So 3 different slides here as we divide your portfolio into growth, inflation protection, and deflation protection. Here's the growth slides. And what you'll see in the first 3 floating columns is your 3 equity sleeves, US equities, EFI equities, and EM. And you'll note that we were overweight, slightly overweight, but well within your rebalancing ranges on all 3 equity sleeves. The rest of the slide to the right at or near their policy targets. Next slide, please. This is your inflation protection portfolio. You know, tips, private real estate, infrastructure, bank loans are still on here, although we have dropped them. I should have taken that out. Again, my apologies. Again, you can see here at or near your targets. Next slide, please. And then in deflation protection, so this is your core fixed income portfolio. You can see at the end of the quarter, we were slightly underweight treasury, slightly underweight mortgages, slightly underweight credit. Again, all within your rebalancing ranges as demonstrated by the gray bars. And as we've talked about, it's also important to look at the duration. Next slide, please. So here are the durations for your core bond portfolio. Your duration targets are in the second row of this column. Your durations at the end of the quarter are in the bottom row of this column. And as you can see, most systems were at or near their duration targets. So that concludes my part of the presentation. Let me pause for any questions or comments on rebalancing or asset allocation. And if not, we'll turn it over to Alex.
Any questions on the asset allocation? I just have one question. Can you go back a couple slides to the inflation protection? Yeah, so my question is, infrastructure is listed as on target, but we all just increased our allocations to infrastructure in the most recent asset allocation. And I thought we were all below the target. So can you explain that?
Yes, these These bubble graphs are inclusive of placeholders.
I get
So,
it. Okay, got it.
yeah,
Understood. Okay, thank you.
yes.
Okay, any other questions for Mike? All right, thank you, Mike. Alex?
John, it's Kevin Holleran. Before we move forward, just let the record reflect that Lou Turco from the LBA is also present.
I couldn't actually hear who it is, who's here for the LBA.
It's Kevin Holleran, and it's Lou Turco is also
Okay,
present.
Turco. Okay, thank you, Kevin.
I also had a question. This is Shuman Ray. I'm sorry, not using the raised hand, for Mike. You showed the new, where the durations are at. And you've recently, I believe the teachers, and you're going to police and fire, do some changing around within the treasury mix. So will that further be lowering your duration? Are those forthcoming, those changes?
Can we answer that in executive session, please?
Sure.
Sure.
Thank you.
We'll do an exec. Okay. Okay, Alex, you're up. Alex.
Thank you, John, and thank you, Mike. Next slide, please. So here we have performance I'm going to present for the first quarter of 21, beginning with a snapshot of plan assets. As you can see in these bar charts, as of March 31st, 2021, in aggregate, the system assets stood at approximately $253 billion. Next slide, please. So for the first quarter of the calendar year, returns by system range from 1.97% for teachers to 3.17% for NICERs. Now the systems posted strong returns in Q1, as you heard from Mike, as global equity markets continued to rally. Now in the quarter, the systems, excluding teachers, outperformed an index portfolio, as you can see in the next to last row of the third column from the left. Now that's primarily driven by the system's exposure to emerging markets, which is actually not part of the index and generated positive returns in the quarter and strong private market returns. Now teachers' underperformance was due to its US equity portfolio, which underperformed as its growth managers gave back some earlier gains. Now, given the strong equity rally over the last year and into Q1, the system significantly exceeded the 7% assumed rate of return last year and also in the trailing 3 and 5 year periods. In addition, all systems have outperformed a 65-35 index portfolio over the 5-year trailing period. I would note, however, that the systems underperformed other large pension plans as measured by TUX in the quarter, as the TUX universe has a larger exposure to private markets, which outperformed the public markets in the reporting period. Next slide. So here we show total portfolio performance for each system for the quarter versus each system's custom benchmark. Now for all systems, excluding BRRRRs, generally performed in line with their custom benchmarks in the quarter, as you can see from the bar chart on the far right-hand side of the slide. And that horizontal line represents the 7% assumed rate of return for the quarter, and all systems exceeded the assumed rate of return. Next quarter, next slide, sorry. Okay, so on this page, when you break down the components that are contributing to the generally flat performance for all systems, excluding BRRRRs, you'll notice that there is a slight positive asset allocation effect. That's the middle bar chart. And that is slightly offset for teachers and BRRRRs, as you can see on the far right-hand side, by manager underperformance. Now that positive asset allocation effect was driven, as you heard in the earlier presentation, by the system's overweight to public equities, which performed well in the quarter, and the portfolio's slight underweight to core fixed income, which had negative returns in Q1. Now for teachers and BRRRRs, the systems managers underperformed their benchmarks primarily in public and private equities and also private real estate. Now in the following slides, I'll highlight performance by asset class. Next slide. So we begin here with US equities performance versus the benchmark. You'll see NYSER's police and fire outperform their respective benchmarks in the quarter, while teachers and BRRRRs slightly underperformed. The story in US equities in the quarters was a continuation of the rotation to value stocks as value outperformed growth in the quarter, similar to Q4. Now for NYSER's police and fire, outperformance was driven by research affiliates and scientific beta. Those are managers that benefited from the rotation to value over growth. However, those same managers are also responsible for those three systems underperformance in the trailing 3-year period. Now for teachers, underperformance in the quarter was driven by small cap active managers and those managers' exposure to growth. And for BRRRRs, underperformance was driven by his mid cap active manager. Next slide, please. So here's the EFI portfolio. So for the quarter, all systems underperformed their respective benchmarks. Now this underperformance was primarily due, once again, to the growth-oriented managers in the portfolio, giving back some of the strong gains they've achieved earlier in the year. Let's go to emerging markets on the next slide. So in emerging markets for the quarter, all systems outperformed their respective benchmarks. Similar to developed markets, value-oriented managers, outperformed growth in emerging markets. And as a result, the system's value-oriented managers actually delivered strong outperformance in the quarter. Let's turn to the next slide. So here we have the fixed income portfolio. Overall returns in the quarter slightly underperformed the benchmark. Now, the fixed income markets were negative in the quarter, with the Barclays Agg down 3.4% as Treasury yields rose, with the 10-year 83 basis points higher to 1.74%, and credit spreads tightened, but only by 28 basis points for mortgage spreads and tighter by 6 basis points for IG credit. So manager performance for the core fixed income portfolio slightly trailed the benchmark. Next slide. So turning to high yield, all systems outperformed the benchmark. Now in the quarter in high yield, CCC rated bonds outperformed, and oil and gas contributed about half of the total return of the benchmark. So very strong performance for the oil and gas sector. The index, the high yield index, returned 86 basis points in the quarter, and the high yield program overall outperformed the index by 31 basis points, with opportunistic managers leading the way in the portfolio. Let's turn to hedge funds on the next slide. So hedge funds for police and fire. The hedge fund portfolio underperformed this benchmark in Q1 and also the fiscal year-to-date periods as the equity markets continue to rally. However, over the longer 3-year period, the portfolio continues to outperform its benchmark. Let's go to private markets, 2 slides forward. So beginning with the OFI portfolio through Q1, OFI is trailing the benchmark since inception, which is the public market equivalent, or PME, plus a 300 basis points illiquidity premium. Now in Q1, the OFI portfolio had an estimated net return of 5.3%, significantly outperforming the custom blended PME benchmark, which returned 1.62% during the quarter. As in Q4, gains in the portfolio for the quarter were driven by managers with broad credit mandates, where those managers were able to be flexible and opportunistic and take advantage of market trends that favor distress, riskier segments, and COVID impact sectors. Next slide. Turning to private equity, performance through Q4 of 2020, again, as performance is reported on a lag, for fourth quarter of 20, since inception, returns for the systems range from 10.6% for NYSERS to 13.6% for BRRRRs. As you see on this chart, police, fire, and BERS outperformed the public market equivalent since inception, which is a Russell 3000. Now, teachers and NYSERS slightly lagged. In all system, returns continue to lag the PME benchmark since inception. Now, overall, the portfolio improved about 68 basis points in absolute returns in Q4 versus Q3, while the PME, the markets increased by 84 basis points. So as a result, the system's PME spread decreased by about 16 basis points on average from Q3 to Q4. Now, I should note that the PE portfolio's valuation continues to recover strongly since the beginning of 2020. After being down 9.5% in Q1, the portfolio was up 9.8% in Q2, and then up 10.3% in Q3, and up 11.8% in Q4 of 2020. Next slide, please. So here we have core real estate. Looking at Q4 of 2020, since inception performance, core real estate investments are underperforming the PME benchmarks for all systems. Now, core real estate valuations did rebound finally by about 10 basis points in Q4. I would note that this is the first markup of the core real estate portfolio since the onset of COVID, as fund managers began to slowly regain confidence given positive COVID trends towards the end of 2020. However, the portfolio's underperformance versus the PME widened in the quarter because markets outperformed the slight increase in the portfolio's valuation. Next slide. And here we have non-core real estate. So as of Q4 of 20, since inception, teachers, NYSERS, and BERS, non-core investments are outperforming the PME benchmark, while police is flat and fire trails the benchmark. In addition, the non-core portfolio was actually marked up 30 basis points in the quarter versus Q3. And you'll recall from the last presentation, from the last quarter's presentation, that this will be the second consecutive quarterly valuation markup since the beginning of the COVID-driven valuation markdowns for the non-core real estate portfolio. Next slide, please. And here we have infrastructure for Q4. Now, performance in infrastructure just continues to be strong, with fourth quarter since inception returns of 12.1% net across all systems. And all systems have outperformed the PME benchmark and the IPS benchmark of CPI plus 400. Just to note, renewables and transportation continues to be the largest sector of exposure in the portfolio at 22 and 21% respectively. And again, North America and Europe are the two largest geographic exposures in the portfolio at 50% and 31% respectively. And that concludes my remarks on Q1 2021 performance. Take any questions.
Okay, if you have a question for Alex, would raise your hand in the reactions tab. Okay, don't see any. Thank you, Alex. So we're moving on to the risk report. Is that right?
Yes, we are, with Dan Haas.
Okay, good morning, everyone. How are you?
Good, Dan.
Hi, Dan. Give me one moment.
No problem, Diane. Okay, everyone see that okay?
Yes.
Okay, great. Thanks, Diane. Can you go ahead? Let's jump right in. As always, we'll cover some highlights of the quarterly reports that you've received through Convene. This, of course, as in the past, we're just using an example system to show you some highlights from the packages that you've received and delve into a couple of themes there. If as before, of course, looking at the top left panel, you notice that the total plan risk for this example for the quarter ended in March was 14.24%. That was down slightly from 14.56% in December. Here, the risk was reduced by declines in market volatility and lower correlations. Those risks were off, or those reductions rather, were offset somewhat by an increase in our portfolio factor exposures. We'll examine these in a little bit more detail on the next slide. Similarly, the benchmark risk, which corresponds to the portfolio policy allocation, is 12.74% in March, declining from 13.25% in December. The table and chart off to the right show you the differences between your portfolio allocation by assets and your allocation to risk. Similar to last quarter, you'll note that while we've allocated a little more than 2/3 of our assets, or 68.42%, to equities, the standalone risk coming from the equity portion of the portfolio was 18.75%, and from fixed income was 6.47%. On a contributory basis, so when you adjust for our allocation and correlations, equity was 12.75% of the overall 14.24%, and fixed income contributed just 1.49% to the overall risk. Again, in percentage terms, that right panel, 90% of the risk came from equities. Quick shorthand there. 90% from equities, 10% from fixed income, similar to what you've seen over the last few quarters. The chart on the right, on the top right there, of course, restates the same information that you see on the table. The asset allocation is represented by the red dots measured on the right-hand axis, and the contribution to overall risk is represented by the yellow bars and measured on the left-hand axis. Looking down to the bottom panel, again, we're plotting the one-year trailing portfolio risk. It's a blue line. The benchmark risk, the red line, and the beta, portfolio beta, the gray bars, for the year ended in December. I'm sorry, ended in March there. As a reminder, this is a monthly plot of our forecasted risk based on one of MSCI's long-term models. And we notice here that the portfolio risk is generally declining over the past year, although not as quickly as the benchmark risk. Over this period, we've noted that reductions in risk due to diversification benefits or lower correlations and reduced volatilities. And those have been offset by increases in portfolio exposures to factor risks. This is the same theme that we've been reporting over the past few quarters and is detailed a little bit more in the next slide, which we'll get into in a second. The reason that the benchmark risk is declining more quickly than the portfolio risk is that the offsetting increase in exposures is less pronounced in the benchmark than it is in the portfolio. In particular, we see that our factor exposures to financials and tech industries like internet, software and IT services, electronics and software increased more in the portfolio than they did in the policy benchmark. That notion is supported by the corresponding increases you see in the portfolio beta, the gray bars there, which increased from a low of 1 in April last year to 1.11 in March. Can we go to the next slide, please? Thanks. So here, we're decomposing the change in risk from December to March into 3 broad categories, and the same things that we've been measuring over the past few quarters. Excuse me. We're looking at the change in volatility, the change in correlations, and the change in portfolio exposures. Pardon me. The change in volatility and the change in correlations categories are market-driven phenomena, meaning that these risks declined in step with market risks and were not the result of specific position weights or tilts in the portfolio. You see those corresponding to the blue arrows in the table there. Bringing your attention to the second line of the table, we see that the reduction in market volatility accounted for a 48 basis point reduction in risk. 34 basis points of this was driven by industry factors led by IT, software, and electronics. We also saw some reduction from healthcare and financials. Moving to the third line, we have a 24 basis point reduction of risk attributed to the correlations. And again, this is continuing a trend we observed the last few quarters where correlations relaxed a bit and offered us a bit of a diversification benefit. Reductions here were also driven by industry factors, including media, software, and energy. Finally, the portion of the portfolio risk that was detached from market trends is grouped in the last line there, labeled change in portfolio exposures. Pardon me. Here, the risk increased by 40 basis points. This was driven by a combination of industry exposures, where we picked up 18 basis points, and spread factors, where we added 24 of the 40 basis points. Financials, oil and gas, and specialty retail were the main industry contributors. and our exposures to high yield consumer discretionary, energy, materials, and healthcare all contributed to the increase in spread factor risk. Can we move to the next slide, please, Diane? Just moving back to the content that you see in the quarterly packages. Here we're showing the factor risk decomposition, and there are two main takeaways here. First, it's good to know which of these factors are contributing to overall portfolio risk and active portfolio risk. You can delve into that detail by reviewing the table at the top left, where we examine our exposures to MSCI's macro factors. Risk here is decomposed among two principal categories, the local market risk and the currency risk. And you can see that the components of each broken out among the rows on the table. Looking along the columns, you see the portfolio and active risks broken out in absolute and percentage terms along with correlations. It's a good reference to show you which factors are contributing the most or perhaps the least to portfolio risk. And the second takeaway here is that these factor risks cut across our traditional asset classes. You can see that on the graph on the bottom where we plot our factor exposure among our broad equity and fixed income allocations. As before, risk is dominated by the equity factor represented by the light blue shading, but you notice that the equity exposure appears in both our equity and fixed income portfolios. Similarly, we see a bit of fixed income factor exposure in our equity portfolios. That'd be the purple bar. Yeah, move to the next slide, please, Diane. And then finally, I thought we'd revisit the standard shock scenarios that are included as part of your quarterly packages. On your blue box reports, we expose the overall portfolio to a number of shock events chosen from among MSCI's library of default scenarios. As you can see here, they often correspond to market events that occurred throughout history and are meant to give you a sense of how the portfolio and policy benchmark would respond if the same economic conditions were to reoccur. So for example, when we examine the specific inputs to replicate the 1994 US rate hike, that top line there, you see the expected shock to, we can see the expected shock to US yield curves and to spreads, but you also see shock inputs to factors like equity beta, exchange rates, and commodities. And they're applied not just for the US market, but also at the country level. All told, there are more than 350 individual shocks to create this scenario. And it's a very comprehensive approach that attempts to recreate relatable, kind of recognizable events in history to our current portfolio. On the other hand, this approach is also quite prescriptive, which may limit the predictive power of these stress scenarios. It's highly unlikely that we'll ever see the same prevailing economic conditions in place when these scenarios occurred. So the results of a similar event happening today could be completely different. As a result, when we run forward-looking scenarios to examine current and developing market trends, we may start by examining these traditional model inputs, but we ultimately enter fewer shocks to the engine, and then we let the models do more of the work predicting the results. For example, when we created the inflation scenario stresses that were presented to you last quarter, we used fewer than 20 specific shock inputs in each of those 4 scenarios. These are both valid approaches, they just have slightly different uses. The standard shock scenarios that we present to you on the quarterly reports, for the most part, are meant to faithfully replicate specific market events and offer historical context. And the forward-looking scenarios that we often show in this forum show indicative results of current and developing market trends. That concludes my comments for the quarterly reports, and I'm happy to address any questions you may have.
Thanks, Dan. Questions or comments for Dan on the risk report? Again, you can use the raise hand function. But I don't see any, so thank you, Dan.
Great, thank you, everyone.
Okay, I believe that moves us on to the compliance update, and that would be Shachi.
Good morning.
Morning, Shachi.
How are you? How is everyone? Good morning, trustees. I am Shachi Bhatt. I'm the Chief Compliance Officer here at BAM. For those of you who may not know me, you may remember every year I provide you with a compliance update. And so before I provide you with that update, I wanted to quickly take you through an overview of our department. Diane, next slide, please. So we have an internal mission within our group, and it's to fortify a culture of compliance that serves BAM and the investment portfolios of the 5 New York City retirement systems. We seek to do this by administering a program that oversees investment firms' adherence to applicable laws and policies, coordinates BAM state, city, and agency compliance requirements, and also provides staff with relevant education and guidance. We believe these are some of the things that are really critical in upholding our fiduciary duty to the systems. Next slide, please. And before I go further, I wanted to reintroduce my team, my very hardworking team. Sonia, Susan, and Mara are the full-time compliance professionals on the group. Ruthie is our summer intern, and Marcia and Chris are our newest compliance fellows. Over the past year, we've had additional compliance staff by way of interns and fellows that have also worked on your portfolio. And together we work together to make sure that we are meeting the mission that I mentioned in the last slide. Next slide, please. I thought I would also, this is in your public session memo as well. It's a quick outline of where we started and where we are now. I joined in 2015, and since then the team and I have really focused on streamlining processes, moving things to a more frequent monitoring process where possible, and automating manual processes. When I joined, we were very paper heavy. Many of our tasks were heavy on data entry, and we've since automated them where we've been able to. And I believe during Mike's update, there was a comment regarding the daily monitoring of our compliance portfolios. I'll mention that in a moment, but we are able to perform that monitoring based on custodian data from prior day. So we don't import, market data feeds or performance related information. We pull in, trades, holdings, and are able to code investment guidelines to monitor them that way. So I think the question earlier regarding more frequent updates than quarterly, I just wanted to outline the distinction between what we do and what some of the other teams do as far as reporting and monitoring. Next slide, please. So as we all know, we've been in working from home for the last 14, 15 months. And in spite of that, I'm happy to share that we were able to accomplish some meaningful initiatives last year. So, first and foremost, the annual ethics and compliance questionnaire, pursuant to your ethics and compliance policy, we issue this every year. The 2020 questionnaire, some of the information is in your memo, and the 2021 questionnaire is currently underway. In fact, responses were due yesterday. So we're working through, the many emails that came in right under the wire. So more to follow on that and during my next update. State Street, our custodian bank, also upgraded their compliance monitoring engine to Charles River Development. It's a firm they acquired, I believe, in 2018 or 19. We were one of the first clients to move aboard this new process, given the amount of accounts and guidelines that we have. And we were able to, migrate that with relative ease and make sure that all of the reports that are generated in this new platform are accurate and are what we expect them to be. And so that was a big initiative that, give Sonia credit for spearheading that, because it was a large project for us and it went really well. We also looked at internal compliance automation. We have, the quarterly trustee reports that we provide to you each quarter. We were able to automate those on our end so that we're not performing data entry, and we're able to really focus more of our time on concrete issues and less administrative work. Diane, next slide, please. We also implemented some software to monitor campaign finance contributions of investment managers. investment managers have what are called covered associates, which are employees defined under the SEC's pay to play compliance rules. And they are prohibited to contribute to public officials' campaigns, if they're also soliciting business from them. And we found software that is able to do that in real time and offers continuing monitoring, which has been really helpful. Again, it reduces sort of the manual data entry component of verifying things against the New York City campaign finance database. We developed a placement agent database. This is a little bit earlier this year. That allows us to keep track of any placement agent that either reaches out to the Bureau and is trying to solicit business from us, or if a manager uses a placement agent, let's say in a foreign country, we've maintained a database of that, and we think that will help us kind of monitor activity a little bit better. It hasn't been an issue, but it's just a good practice to have. And last but certainly not least, we're still dedicated to training. We performed it virtually this year. I'm sure people loved all of the Zoom calls, but we focused on material non-public information, fiduciary duty that actually just wrapped last month. And then, we work with the Conflicts of Interest Board to tailor make conflicts of interest training that's more investment related, so that people have a really strong idea of, what they need to do as well as fiduciaries and as city employees. Next slide, and I will take questions on public session or public session memo questions. Anything you have.
Questions for Shachi on the public compliance report? Use your raise hand button. But I don't see any questions, Shachi. So that concludes your report.
I will return in executive session to provide just a few more pieces of content, but yes, that is all I have to offer in public session.
Okay, thank you. Thank you for that offering. Okay. So Alex, if I'm not mistaken, that concludes our public session agenda for today.
Yes, it does.
Thank you so much. So with that, we're going to entertain motions to enter executive session at all four boards. Let's start at police. Is there a motion at police to exit public session and enter executive session?
Motion to go into executive session.
Second, John Dorsa.
Thank you, Joe and John. Any discussion? All in favor of the motion at police to exit public session and enter executive session, please unmute yourselves and say aye.
Aye.
Aye. Aye.
All opposed, please say nay. Any abstentions? Motion carries. Next, at NYSERS, is there a motion to exit public session and enter executive session?
Motion, Ruben Torres.
Thank you, Mr. Torres. Is there a second?
Second, then David.
Any discussion? All in favor of the motion at NYSERS to exit public session and enter executive session, please unmute yourselves and say aye.
Aye. Aye.
All opposed, please say nay. Any abstentions? Motion carries. Next, at teachers, is there a motion to exit public and enter executive session?
Don't move, John.
Thank you, Mr. Brown. Is there a second?
Second.
Thank you, Ms. Penny. Any discussion? All in favor of the motion at teachers to exit public and enter executive session, please unmute yourselves and say aye.
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 All opposed, please say nay. Any abstentions? Motion carries. And next, at fire, is there a motion to exit public and enter executive session?
Motion, Paul Nevins.
Thanks, Paul.
Second, Eric Bischoff.
Thank you, Mr. Bischoff. Any discussion? All in favor of the motion at fire to exit public and enter executive session, please unmute yourselves and say aye.
Aye.
All opposed?
Aye.
Any abstentions? Motion carries at fire. So we are now in executive session at all the boards that are in session. So with that, let's please bid the public goodbye. Any members of the media, let's turn the cameras off.